travelers, reward enthusiasts, and credit score builders. In this channel, I cover all types of credit cards. I will give you an overview of the card, its pros and cons, and my take on the card. If you have a credit card that you'd like me to cover, let me know in the comments below. Today's video, however, will be a little bit different. Instead of providing a review for a credit card, I'll explain to you what an APR is, because it's important to understand everything when it comes to credit cards. Credit cards have become an essential financial tool for many individuals, offering convenience and flexibility in managing expenses. However, one crucial aspect of credit cards that cardholders must understand is the annual percentage rate, APR. APR, or annual percentage rate, is a standard measure used by credit card issuers to express the cost of borrowing as a yearly interest rate. It takes into account not only the interest charges, but also any additional fees associated with the credit card. APR serves as a basis for calculating the interest accrued on outstanding balances when cardholders carry a balance from month to month. In many countries, lenders are equally required to disclose the APR to borrowers for certain types of loans. This ensures transparency and helps borrowers to understand the true cost of borrowing. Additionally, regulations may govern how APR is calculated and disclosed to protect customers' rights and prevent deceptive lending practices. The APR on a credit card may consist of several components, including interest rate, annual fee, and penalty fees. The interest rate is the primary component of APR and represents the cost of borrowing money. It is usually expressed as an annual percentage and can vary depending on factors such as the creditworthiness of the cardholder and prevailing market rates. Some credit cards charge an annual fee for the privilege of using the card. This fee is incorporated into the APR calculations and affects the overall cost of borrowing. And last but not the least, late payment fees, over-limit fees, and other penalties imposed by the credit card issuer are also factored into the APR. It is crucial for cardholders to understand these fees and how they can impact their overall debt. There are also different types of APR, not only penalty APR. The purchase APR, also known as the standard APR, is the interest rate charged on the outstanding balances for purchases made with the credit card. This is the most common type of APR and is applied when cardholders carry a balance from one billing cycle to the next. Some credit cards offer promotional balance transfer rates, allowing cardholders to transfer balances from one credit card to another. The balance transfer APR is the interest rate applied to the transferred balance. It is often lower than the standard purchase APR and may have a promotional period with a reduced or 0% APR of a limited time. When cardholders use their credit cards to withdraw cash from an ATM or obtain cash equivalent transactions like purchasing traveler's checks, they are charged a cash advance APR. Cash advance APRs tend to be higher than purchase APRs and often have additional fees associated with them. Some credit cards offer an introductory APR as a promotional offer to attract new cardholders. Introductory APRs are typically lower or even 0% for a specified period, which can range from a few months to over a year. After the introductory period ends, the standard APR will apply to the remaining balance. And lastly, a variable APR is tied to an index, such as the prime rate or the U.S. Treasury bill rate. The APR fluctuates based on charges in the index, resulting in changes to the interest rate charged on the credit card balance. Card issuers typically provide a margin above the index, which remains constant. It's important for credit card users to understand the different types of APR associated with their cards, as each type can have a significant impact on the overall cost of borrowing. Reading the credit card agreement and reviewing the terms and conditions provided by the issuer will provide specific information on the APRs applicable to the card. Understanding APR is of crucial importance for a few reasons. First, by understanding the APR, consumers can effectively compare different credit card offers and select the one that suits their financial needs. A lower APR indicates lower borrowing costs and can save cardholders a significant amount of money over time. Second, APR plays a crucial role in determining the cost of borrowing a credit card. By comprehending the APR, cardholders can evaluate the affordability of carrying a balance and make informed decisions regarding their credit usage. A higher APR means higher interest charges and can lead to long-term debt if not managed responsibly. Third, understanding the APR allows individuals to better budget and plan their credit card usage. Cardholders can estimate the cost of financing their purchases and adjust their spending accordingly. This knowledge empowers consumers to make conscious choices and avoid accumulating unmanageable debt. Fourth, APR knowledge enables cardholders to develop effective payment strategies. By understanding how interest charges are calculated and added to outstanding balances, individuals can prioritize paying off higher APR balances first or consider alternative payment methods to reduce interest costs, such as making larger monthly payments. And fifth, failure to understand APR can lead to unintended debt traps. Consumers who are unaware of the high interest rates associated with certain credit cards may find themselves struggling to make payments and falling into a cycle of increasing debt. By understanding the APR, individuals can make informed decisions, avoid unnecessary debt, and maintain better financial health. You might wonder, isn't the interest rate the same as APR? Let me tell you that there are some differences between APR and interest rates, or fixed and variable APR. While the interest rate is the percentage charged on the borrowed amount, APR goes beyond that by factoring in other costs associated with the loan. These additional costs may include origination fees, closing costs, points, and other finance balances. By incorporating all these expenses, APR gives borrowers a more comprehensive understanding of the total cost of borrowing. Also, APR can be either fixed or variable. A fixed APR remains constant throughout the loan term, providing borrowers with a predictability in their monthly payments. On the other hand, a variable APR is tied to an index, such as the prime rate, and fluctuates the changes in that index. Variable APRs can go up or down over time, affecting the borrower's interest charges. APR is particularly relevant to credit cards, as it determines the cost of carrying a balance from one billing cycle to the next. Credit card APRs can vary widely, depending on the cardholder's creditworthiness and the type of transaction, such as purchases, cash advances, or balance transfers. Understanding the APR on credit cards is crucial for managing credit card debt effectively. With this, the lesson about what is an APR ends. I hope you enjoyed it and that it was interesting for you. Thank you for watching, and let me know what you think of it. These videos take a long time to make and are a labor of love. If you would like to see my channel grow, please help spread the word.